Thank you for joining us for another episode of the Financial Commute. I'm Chris Gillespie, your host. I'm really excited to have Raj here. He's a manager of our SPAC Strategy, Special Purpose Acquisition Company. It's a really unique way in terms of how they invest and why we use it. Raj, I know that there's a lot of acronyms that get thrown out in our world, and some of it's over a lot of people's heads. Tell us, what is a SPAC?
Okay, so a SPAC is a special purpose acquisition company, and it's a vehicle whose sole purpose is to facilitate a merger or a business combination between the SPAC and a privately owned enterprise. Okay, and the way the SPAC does this is by issuing units to the public. Each unit is issued at $10 per unit and comprises of one share and one warrant. The proceeds from the issuance are placed in a trust account overseen by an independent trustee at a major U.S. financial institution. And the proceeds are invested in short-term U.S. Treasuries, so very safe. Once that's done, the SPAC team then goes out and looks for a business combination. And what's important here is that they have a limited amount of time to do that. It's usually 18 to 24 months. If at the end of that time period they're unable to find a business partner, the cash is returned to the investor with interest, no questions asked. If, on the other hand, they are successful, then the investors have the right to review the business combination, vote on it. You can vote yes or no. And you also have the right to ask for your money back if you don't like it. So again, no questions asked. Basically, you get a front row seat and you review the deal. And if you don't like it, you can pull your money out.
So SPACs have come into the news the last few years because of what happened during COVID. Access to capital was very difficult. But then there's all these vehicles, these SPAC vehicles that are sitting there with cash on the sidelines, and they allowed people to still transact businesses or find businesses to take public through the form of an IPO. And that created this frenzy and this excitement, and then now SPACs are all of a sudden in the news. How long have SPACs been around to help private companies go public?
They've actually been around since the late 80s and early 90s, but not in the form that we have today, not with all the safeguards that we have in place. The current crop of SPACs that we see now with the right to redemption with money sitting in treasuries, I would say that goes back to about 2005 when we first started investing in this space. And it's kind of funny how we fell into it because we actually had a client out in Long Island who called us and said, look, hey, I have this broker calling me every day about this new IPO that he's doing. It's something called a SPAC. And he says you can't lose.
Yeah.
So every time he tells me that, I hang up the phone on
right.
him.
Most investment people say you can't lose. It's like run the other direction.
Go. But he keeps calling me back. So can you guys, take a look at this? And we said, sure, we will, because a lot of what we do has to do with shareholder activism and reviewing, proxies and, we're writing our own proxies and all that. So we are familiar with it. And we did review the documents, and and what the broker was telling us was correct. So that's how we got involved with SPACs in a small way at first, just to make sure that everything that was being told was true and that it would pan out that way. So we have been doing this since 2005. Yeah.
What do you like most about what you do with regards to investing in SPACs?
I think what's unique about SPACs is the structure.
Mm-hmm.
Okay, it gives investors the right to redeem if they don't like a deal. So essentially, you're getting a free look at a deal. You review it. You don't like it, you get out. If on the other hand the deal is good, the shares and warrants that you get are going to trade higher, and it's going to be profitable for you. So it's the safety plus the optionality.
Yeah.
Okay, so you grind it out. You make the rate that U.S. treasuries are paying. You buy those at a discount, so you make a little more than that. And every now and then, you have a SPAC that announces a well-received deal, and that's all gravy. So that's kind of what we like about it. The structure. That's where the edge is.
Whenever I think of a private company I'd like to go public, I think of In-N-Out, but that's because I'm out here in California. When you look at investing in SPACs, there's two different ways to invest, right? There's the pre-merger, so it's the raising of capital, and that money sits in U.S. Treasuries, and then they go try to find a deal to then take it public. And then there's the post-merger, when that SPAC merges into that new company and becomes a publicly traded vehicle. You guys play it a little bit differently. Share us with how you like to invest in this space, because you mentioned the protection and the optionality.
Yeah. So we never stay in a SPAC once a deal is consummated. Okay, for us it's all about pre-merger, because once a deal is done and it's de-SPACed, to use the term, what you really own is a small cap or a micro cap operating company. It's no longer a SPAC, and all the risks that come with that. And there's no edge in it. We don't have any edge in analyzing, companies in different sectors, and I don't think very many people do. So the edge is pre-merger, which is really the free look at a deal and your right to redeem. Now, if it's a good deal, okay, that time between the deal is announced and the deal is consummated can take anywhere from 4 to 7 months, because of the SEC review process and allowing shareholders time to review the proxies and allowing them time to vote. There's ample time to sell your stocks and warrants if it's a well-received deal and if the shares are trading higher. So there's plenty of time to do that. There is no reason to stay past the merger deadline, because then there's no edge.
There's no protection on the downside.
Yeah.
So you like to get in at the beginning, or even a little bit below that $10 mark.
Correct.
If there's excitement or announcement around a deal, and that goes from $10 to 12 or 13, you're going to take some money off the table to help protect investors. But along the way, if the deal doesn't go through, or if no deal gets done, you're being returned your $10 at the end, plus the interest from the U.S. Treasuries that you're making along the way.
That is correct. So let's say it's not a well-received deal, right?
Yeah.
So then the shares of the SPAC are going to trade below the cash that's in the trust account. So at that point, you obviously don't want to sell it for a loss. So you'll just wait till you have the right to exercise, and you'll just get your money back.
Yeah.
And if it's a good deal, it's trading higher than the cash in trust, you'll just sell it in the open market.
I know that we love this space from like a bond substitute, right? I mean, you have the protection on the downside. You can earn some U.S. Treasuries. It's a situation where it's very hard to lose principal money, so you're protecting capital, but then you have the opportunity to earn a really decent return over time, call it 5 to 7% if certain deals get done. We're in an interesting time now with interest rates rising, inflation. How do you view the opportunity for investing in SPACs today and looking forward?
So with the short-term U.S. Treasuries paying 4%, up from, say, 0 a year ago, the opportunity cost of owning a SPAC has gone way down. Okay, because a year ago, if you owned a SPAC and they didn't announce a decent deal, or if they liquidated, you would have gotten back your money plus interest, but that interest was zero, right? So essentially, you're just getting your $10 back. But now that's changed, right? So now, if a SPAC doesn't announce a deal, then you're going to get your money back plus the 4%. So I think I think things I think it just makes the space more attractive and interesting. I think in the short term, what we're seeing is a bit of a hangover from, the SPAC mania that we saw, about 18 months ago, where there was just tremendous issuance of SPACs.
Yeah.
So like right now, if you look, there's over 650 SPACs out there. Either they've announced deals, haven't completed it, or they're still searching for deals. And I think they control about $260 billion in capital. So there's a lot of competition if you're a SPAC sponsor looking for a deal. But in the first half of next year, about 50% of those SPACs are going to disappear. Okay, so the playing field is going to change, and I think for the SPACs that remain, I think it's going to be a lot easier to find a well-received deal, because also don't forget that valuations are way down. So if you're a SPAC sponsor, I think it's probably there's a lot more value to be extracted and just more abilities to take advantage of the private to public arbitrage that everybody talks about. So I think it's going to be I think it's going to get interesting again. I don't think we're going to see the frenzy that we saw 2 years ago, where every deal that was announced, the price would go from $10 to $20
it was amazing.
overnight. Yeah. But I think for deals that are well structured and that there's value, I think you will see the optionality. So it'll be on a case by case basis, but also for the strategy to work and for you, and your clients to hit your bogey. You don't need every deal to be a home run. I think you have, one or two deals that are home runs. If you have a few more that announce decent deals, you make a little money on the warrants, and the rest, even if you get your money back with interest, you'll still hit your bogey.
Yeah.
Because don't forget, you're never losing.
Right.
So you never have.
You
to
have
make
that downside protection.
You never have to make up, that loss.
Right.
So that's very powerful.
I mean, you need 100% return to make up for a 50% loss.
Exactly.
And so protection of capital becomes really important.
Yeah.
What are some of the biggest misconceptions or challenges that you face in investing in SPACs or communicating your story?
Yeah. So I think the press on SPACs is just 100% negative. There's no focus on the structure. There's no focus on where the SPAC has its cash invested, which is in short-term treasuries. All the focus is on the D-SPACs and how those stocks have done, and which I think for guys like you and me, I think it's good because it gives us an edge, right? Yeah. It's something that nobody else is focusing on, so we do our thing quietly, right. And I think that's great. But I think that's what the issue is, and if you look at the D-SPAC index. It's down, I think, about 49 or 50% year to date. But to be fair, if you look at an index of IPOs, that's down, over 50%.
Yeah.
So one really has to, factor in, the climate that we're in. If you look at SPAC IPOs, 2021, I think you had about 120 billion in IPOs. This year, you've had 13 billion. Mm-hmm. But if you look at traditional IPOs, I think that's down like over 95%.
Yeah.
And I think the traditional IPOs have raised about $6.5 billion this year. So, it's a tough time in the capital markets. And, part of it is, of course, I think with SPACs, there was some mania as to what was going on. And there were a lot of self-inflicted wounds and just the sheer number of SPACs that were out there. But the market is a self-correcting mechanism.
Yeah. And
all these SPACs, where you had two guys on a laptop and said, let's start a SPAC, that's going to be flushed out.
Yeah.
And at some point, I think rationality will prevail. So
I think so. I mean, it's normal in the investing world to see irrational times at times. That's just what happens.
Yeah.
I think about the number of companies that went public through the form of a SPAC that were pre-revenue, never even sold a single unit, and their price went from $10 to north of 30, 40, or even a couple instances up to 80. And then now you look at those companies today, and the stock price is probably down at 5 or 6. So,
right.
I love the fact that you found a place to help protect capital, but also earn people a reasonable rate of return without taking on additional risk beyond the de-SPAC or the post-merger. So thank you for talking with us today and sharing with us your story.
Thanks for having me.